Before we dive in, a quick note. If you want weekly tools to grow and lead your business, sign up for my free newsletter at stevepreda.com/newsletter. Hello, everyone. Steve Preda here, and my guest today is Tanner Taddeo, the CEO and co-founder at StableC, an autonomous treasury management platform that helps finance teams and global businesses access capital market products and move money around the globe to 40 currencies with the cheapest FX rates. Tanner, welcome to the show.
Steve, thanks for having me. Excited for the conversation today.
You know, it's very interesting that this is how you position your business, because most businesses in your industry, as I see them, they position themselves with low transaction fees, but really the money is made on the FX. So if you do preferential FX rates or cheap FX rates, that can be a very transparent way of getting business. So I don't know if that connects to your personal why, but I'd love to learn about your personal why and how do you manifest it in your business.
Yeah, I mean, definitely, at StableC, we're very mission driven in terms of everything that we do. The team itself, comes from Block, which was formerly known as Square. And everyone at the team has been focused on building, products for the real economy, for consumer use cases, for business use cases, etc., over the course of everyone's career. And so when we started StableC, our primary thesis was, with blockchain, with stablecoin, with some of the tokenized capital markets products like money market funds, bonds, equities, etc., that are coming on chain, how can you really take Wall Street grade financial services and provision them out to Main Street for businesses that need them the most? And so the why for StableC, for myself, for the team, is really around helping businesses drive greater capital efficiency in their operations. And, we service businesses in the real economy that typically make widgets or, some sort of physical hardware devices, and they need to send them around the world. And we help them because we give them access to different types of capital markets products. So money markets and private credit and fixed income products, etc. And then we help them move their money around the globe a little bit more efficiently than they could with either their state bank or their credit union or some third-party, cross-border payments provider. Because our firm thesis has always been, if you and I ran like Coca-Cola or like a large organization, we would have like the best-in-class transaction banks helping us put our idle capital to work at every point in time during the day. If you and I ran like a steel manufacturing company in Missouri, you typically have a checking account and QuickBooks, and that's about it. And so for us, it was always about helping businesses grow, save more money, and then operate more efficiently with some of the new technologies that are out there today.
So that means presumably that what you focus on is more about the investment side of the business rather than, crypto and blockchain and helping people access financial products through the blockchain. Help me understand a little bit what you do and how is it different from what people can get from banks.
Yeah, so everything that we do, all the technology that we build and provision is on chain. So all of the capital markets products are tokenized. So tokenized bonds, tokenized equities, tokenized fixed income, tokenized money markets. All of the payment services and settlement services that we offer are through the use of stablecoin, and we can send that around the globe, settle it instantly, and then have low FX rates off the back of that. And then we have like some of our AI advisory services. But from a broad paintbrush perspective, StableC, you've got three products that hang off of our platform. You've got capital markets, you've got global settlement, and you've got advisory services. And then with all of that, we share a common architecture, and that architecture is built across many different blockchains. And then we utilize stablecoin and we utilized RWA tokens, or like real world asset tokens, to provision those use cases. So everything that we do is stablecoin native, but we don't lead with that from a messaging perspective. And the reason we don't lead with it from a messaging perspective is that if you and I ran, a bakery here in Brooklyn, New York, and we had a point of sale terminal that just got offered RTP access from the Fed for like instant settlement, the bakery owner doesn't really care about the technology underneath it. They just care, do I trust it? Is it going to get me my money quicker? And is it going to be cheaper than my current alternative? How it happens, not very many people care. Unless you're in the industry and you're like a builder, product manager, etc., and you want to like nerd out on the actual mechanical nature of how the product works. But for us, it's always been leading with the narrative of like, what is the value proposition and how can we drive greater value to the businesses? So that's how we lead. But to your point on like what the difference is with any new, technological paradigm that occurs, rarely is it so disruptive in nature that like folks can't recognize it. Everything that happens in terms of the innovation paradigm is typically you stand on the shoulders of giants and you make things incrementally better. And so for us, like what we do with capital markets is like the first value proposition is that many businesses in the United States just don't have access to a diverse array of capital markets products. So the first thing that we have done is just provision access, which is an innovation in and of itself. Because in the traditional markets, if you want to access a money market fund or a fixed income product, you typically have high hurdle rates, meaning that as a business, you need to invest at least $10 million at the asset manager in question. You need to hold that there so then you can get access to all these products. With us, you don't. There's only a $1 minimum to clear. So I think most folks can handle a $1 minimum. And then secondly, like as things go on chain, the value proposition there is that you have 24/7, 365 liquidity and tradability. And so what that means is that just from a money market fund perspective, the interest accrues daily and it pays out daily. So you get this interest that is dripped into your account daily as opposed to waiting for a month. You also have the ability, so like let's say that you and I run this bakery in Brooklyn. Let's say that we close our business on Friday and we've got 100,000 sitting in our checking account and we're closed on Saturday, Sunday because it's July 4th holiday. So we know 100,000 is just going to be sitting in our checking account Saturday, Sunday, not being put to work. With StableC, you can put that to work in a tokenized money market fund because it operates 24/7, 365. So what we see is like businesses now that close their books on Friday can just do an auto sweep into a money market fund, generate yield Saturday, Sunday, get back to US dollar for their open of business. And again, it's one of those things where it might not sound like the most revolutionary concept in the world, but if you can help businesses, especially in the mid-market, lower mid-market, operate a little bit more efficiently, I mean, saving an additional $20, $30, $40,000 a year is a big value add to them in the real economy, right? If you're a large Fortune 100 company, probably don't care, or it's not as valuable. But for us, the companies that run on us, like these small increments standing on the shoulders of giants, a small derivation in innovation is actually really valuable for the end user.
Well, I think it is because looking at the inverse of it, I used to be in banking and I know that one of the biggest moneymaker for banks is float. So it's basically the money that doesn't earn interest, which they have access to just because they cash the check a day later or make the wire 2 days instead of 1 day. And you're essentially, what you're doing is you're taking this money from the bank and you're giving it to the company that actually should have it in the first place, right?
Yep.
Then the question is, how are the banks going to survive if you take away their bread?
Yeah, I mean, that is the debate that's happening right now. I mean, I think if you're one of your GSIBs, like your major banks are going to be okay. So top 25 banks in the US are going to be just fine. They make money in tons of different ways, and you're not going to disrupt that trust ultimately. In the long tail is where I worry because, a lot of credit unions and a lot of state banks, they just don't offer, they're smaller banks, right? So they're not managing, they don't have a ton of money in virtue of assets under management. So with the deposits that they receive, they need to turn around and recycle that because it's fractional depository lending, meaning that like if I have a checking account, I put 10 grand into it, the bank isn't turning around with that 10 grand, making money on it somehow. And you got to think, how does the bank actually make money on that? Well, they typically make it through debt facilities. So mortgages, auto loans, student loans, cards, etc. They're putting it to work in high margin financial products back into the economy. They're not taking that and then buying some money market fund from an asset manager where they make 10 basis points and provisioning that out to the businesses, right? There, I think that like we're seeing a lot of companies move off, like they're taking their money from their checking account, moving it to StableC because we can put it in these capital markets products. I think that like, overall, that's a net positive for the business because the business now has a higher degree of operating capital on hand that they can make money with. But by the same token, if the state banks and the credit unions, if they don't wake up and they don't respond to this, their depository base will be, if not fully eroded, it'll be tarnished and diminished. And what that means for local community health, I'm not sure, because banks do play a very important role, and especially credit unions and like local banks. Like, your local community the best. And so, you lend back into that community with the deposits that you receive from that community. So there's a cyclicality to it, which, has some poetry in it. And so, it's not apparently clear to me that some of this stuff is going to be a net positive, but at the same time, living in, one of the most capitalistic countries in the world and markets in the world, there's a clear demand for this. And if the banks aren't going to wake up and serve it, we'll be there to help businesses do what's best for them.
Yeah, I mean, it's the invisible hand, right? You increase the efficiency, which will force the banks to also increase their efficiency. And yeah, the smaller banks might have to be more innovative, but they are more nimble. So maybe there are other ways that they can serve the community. So I'd like to switch gears here and talk a little bit about frameworks. So this is a podcast of frameworks, and 350 episodes in, I'm always looking for some kind of a framework shortcut, a mental model that you have come across or developed yourself that helps you make more sense of the world around you, get something done. It can be explained in 3 to 5 steps, something like that, and which the listeners might get some ideas out of and be able to improve their businesses. So what does come to your mind for you?
Yeah, I mean, two things. I'll start with a high level analogy and then go a little deeper. But like, it's the World Cup right now, so I don't know if you or any of your listeners are following the World Cup. But if you watch Messi play, his playing style is a great analogy for startups. And whether that be a startup, externally where you raise venture capital, or even just entrepreneurship, if you're inside of a big company and you're on an innovation team, etc. From the outside, it looks like startups are always building things and they're always moving fast, etc. But in reality, if you watch Messi play, Messi really doesn't move that much on the pitch. He just like sits around, he observes, he watches, and then when a hole opens up and some opportunity opens up, he breaks for it, and then he goes and he executes. Mm-hmm. But he spends the vast majority of time just sitting there, tinkering, observing, watching. And then if you're watching him, you're like, he's not working that hard. He's just sitting around. And then he goes and he executes. But he's always observing. He's always watching. And there's a real learning in that. I feel like Silicon Valley, as it relates to startups, there's this pressure that you always have to be building, you always have to be shipping, you always have to be just like constantly grinding. I think that wisdom is actually counterintuitive, because you want to have a thesis in the market, and then you want to be able to test that thesis quickly. So like in some respects, you do want to be shipping all the time, but you don't want to be working for the sake of work. You want to have a thesis in the market. You want to be building towards that thesis that will happen in the next 6 months, 12 months, 2 years. And then you always want to be like learning and talking to the market, because like when that hole does open up, you'll have the right product at the right time to go and execute on it. So I think that that's something that like we have learned, of like being patient and staying resolute in your conviction of like what you're building, is right. And it can't just be a gut feeling. It has to be validated by the market. So we do a bunch of A/B tests every 30 days. Where we have an idea about a feature or a product or a direction we want to take it. And the thing is like, if you can't get 5 CEOs on the phone in 30 days to validate if a product is gonna be interesting or not, then that's signal in and of itself, right? So for anything that we do, we always have like a thesis on the market, and then we spend 30 days testing it. And at the end of those 30 days, we get some feedback. The reason why we do these A/B tests, just to drill down into one level further, is that the idea of a startup or a product that you have in your head, it's a living entity. It's always evolving on the basis of who you talk to, what your team is thinking, what you're reading in the market, etc. And then you're trying to take that living concept and then plug it into a market. But the market itself is also living, right? You've got regulations, you've got different macroeconomic cycles, you've got companies who have budget, didn't have budget, people getting laid off in different organizations. Like the market itself is living and evolving. So you have this idea that is living and evolving, and you have a market that is living and evolving. And you need those two things to stick together. And so for us, it's like we're always wedded to this concept that product at time A is not going to be product at time Z. You need to constantly be doing A/B tests to figure out what that right fit is. And then when you have that fit, you need to double down on it and grow it into a line of business. But you also need to recognize that there are very few businesses in this world that have been around for more than 200 years, if at all. So whatever your original product idea is, or whatever the feature that gave you product market fit is today, you have to consciously be aware that like, hey, that's not going to be the thing that gets us to IPO in 5 years' time.
Mhm.
So you can't be lulled into this false sense of security. You always got to be waiting, observing, testing, experimenting, growing. And then if you see opportunity, you strike.
Yeah, this is fascinating. I mean, especially now, things are moving very fast with AI creating capabilities over the time for people to test products or to create capabilities that then get disrupted in a couple of months. So it's interesting that you say that you have to stay resolute in your conviction. So there is a tension there. So you build a thesis and you stay resolute, but then you're testing and the market might tell you to not be resolute. And then you also told me that companies, they don't live forever. So how do you resolve this tension of, being stable with your thesis and not let your conviction be upended, but also be nimble and the changing market dynamics and everything to respond to it. So how do you
Yeah.
manage the tension?
Yeah, it's a good question. I mean, there has to be a high level thesis, right? So for us at Stable C, it is as simple as in 10 years from now, will more finance teams and businesses be on chain or off chain than today? And so our high level conviction is like in 10 years' time, more businesses will be running their treasury stack on chain. So that's our conviction. Like we know come hell or high water, that is going to be where the puck is going to be in the future, and we're going to skate to that future. So if you start with this high level conviction that more companies are coming on chain, that is like what we're building for. Now, how they come on chain is a matter of debate, which is where the A/B test comes in, right? We originally thought it was going to be for payments. So we built all this stablecoin infrastructure to do global payments in 40 different markets. Turned out to be not the case, actually. And then we started tinkering as we saw the data coming in, was like, okay, some companies are using stablecoins for payments, but like there's a bunch of inefficiencies. That world's still going to take 2 or 3 years to wake up. Where is the wedge in the market today? And so when we started experimenting with capital markets products, we found that there was this massive opportunity that just businesses didn't have access to a diverse array of yield bearing strategies, and they wanted that. And so that was where like, okay, let's get businesses into the on-chain economy through capital markets. And then what we're finding is like, as folks come onto the platform, everyone uses us today for capital markets. And then, 20, 30% of our companies then say, actually, I do have a cross-border payment need. And I already hold money with you. Can you facilitate that payment or that settlement to Mexico, Colombia, Brazil, South Africa, et cetera, et cetera? So for us, when I say you need to stay resolute in your conviction, like our why is always we want to take Wall Street grade financial services, provision them out to Main Street. The conviction behind that is that you can do that through on-chain technology. And then in 10 years from now, more businesses will be on-chain than off-chain. How we get to that future in 10 years, who knows, right? And that's where the fun of the startup is you're always testing. And so for us, we've waxed and waned on different product strategies primarily because the market has changed, and as people start to educate themselves on what the value props are, you see where folks find value, and then you build to that value. And in theory, in 3, 5, 7 years, we should be living in a world where more companies are operating on chain, and then they might use that full product suite. But off the gate, it's kind of like, where is that value, that wedge? You charge as hard as you can into that wedge, and then you continue to expand your product set over time. All with that high level conviction of like, in 10 years from now, we believe that more businesses will be on chain than off.
So basically, you want to find the point where you can penetrate that market opportunity and then it's land and expand kind of thing. And then you expand from there as the market opportunities evolve over time. But you already have a customer, you're already building trust with them, and now they're going to be more disposed to buying from you.
Yeah, that's right. I mean, and I think it's interesting from a mental place being a startup because you're forced to think so short term because you just need to generate revenue, get to the next capital round, et cetera, et cetera. So you're always building for the moment. But what we try and do at Stable C is we try and think as if we were already a vanguard and a large company to the extent that we have the luxury of planning for 10 years. If you think about it in that regard, it takes a lot of the day-to-day anxiety away. It's a little bit like, if you listen to Warren Buffett, anytime that there's volatility in the market, he's like, well, it doesn't really bother me because I'm investing for 50 years. So like, is it up 20%, down 20%? Who cares? in 50 years it's going to be up 200%, so that's all I'm worried about, right? And there's a real luxury when you come and think about it that way. So that's why I think if you're founding anything, or if you're starting something inside of a company as like an intrapreneur, you need to have a strong conviction on where the market's headed in like 5 or 10 years, and then you need to test towards that future. But that also makes the day-to-day operations of the business a little bit more palatable, because you're not just, so often you can get caught up in this whipsaw of like, big company A launched this product, regulation came down, wiped out this company, this competitor raised Series C, and they have way more money in the bank than we do. And so you can get caught up in all this minutia, but it doesn't really matter if you sit back and you say, I know that I'm going to find a way to make this business exist for the next 10 years.
Mm-hmm.
In 10 years' time, what does the future look like? Do I feel strongly that that's going to be the case? Cool. I'm going to build towards that future. And then whatever the headwinds are in the interim, they're just short-term temporal problems that like kind of come and go along.
Yeah, I mean, I totally agree with you. And interestingly, 20 years ago, or 25 years ago, I didn't feel like I had enough time to think that long term. But now that I'm older, I actually am more patient to have the long view, which is very counterintuitive. And Dan Sullivan, who is a coach and the founder of Strategic Coach, he is now, I think he's now north of 80. And he has this thesis that even in his age, he has a 25-year plan, and that allows him to actually create more value. So that's fascinating. So switching gears here. So what drives growth in your business right now?
Yeah, so we govern the business with an asset under management model. So, we have USDC, we've got money market funds, we've got fixed income products, we got Bitcoin on platform. So we just look at overarching platform balance. And so like that's the primary, very simple heuristic for how we define success, is like, is that thing growing month over month, quarter over quarter? That's how we define growth and measure our growth. But again, the value prop in terms of what drives that, like why do actually companies sign up to StableC? Primarily because they just don't have access. Every business that we have talked to so far, and honestly, every business that I've interacted with has idle cash sitting in a checking account someplace.
Mm-hmm.
Full stop. And that idle cash could sit there for the weekend, i.e., 2 days, or it could sit for a quarter. Like if you're gearing up for quarterly bonuses in Q1, you will escrow like $1 million, $2 million in Q4 so you can pay out in Q1. Not just the US economy, but every economy, there's just cash sitting around at a bank and it's being underutilized. And so like for us, when we go and finally, chat to businesses in the mid-market, lower mid-market, even SMBs, we have a customer on platform that they invest $2,500 every week. It almost looks like a checking account in some. It almost looks like a retail behavior in some ways, but they do it because they say, "Hey, I don't make a lot of money with my business, but if I can ink an additional 2-3 grand at the end of the year, like that's valuable to me." And there's a real poetry to that because it's like they've never had access to it. They've always wanted it, but banks, large and small, won't go build for the long tail of the economy. And so finally, we show up and we say, hey, here's your menu of investment options. Here's like the risk profiles. Here's how you should think of it. Here's like based on the seasonality of your business, we can get you into the right products. There's real utility there. And that's what kind of like drives the value proposition and into the growth of the business, and the growth of businesses kind of assets under management overall.
Mm-hmm. So you're looking for opportunities where you can be additive to customers, where there's a situation where maybe there's a gap in the market or there's friction that they are experiencing with investing their money, and you can be the wedge in that situation and offer them, a 3x better solution.
Yeah, correct. And again, like we don't want to, our tagline internally is keep your bank, upgrade your capital, because like we really don't want to compete with the checking account. Like where you run payroll, where your invoices land if someone pays you, your day-to-day spend, like keep your banking relationships, because like it's very difficult to usurp that. And also we don't want to get into that. That puts us squarely in this like neobank realm where you've got like great companies like Mercury and Row and Ramp and Brex and 1,000 other companies there. We don't really want to go compete with that. We're more of like a if you had the privilege of working with some of the largest transaction banks in the world, that's what we're trying to be and essentially provision those services out to the real economy, which is typically access to capital markets, access to global foreign exchange for payments and settlement, and then advisory services, tax
Almost like
reporting, et cetera, et
a
cetera.
democratized private banking
Yeah.
service.
Yeah. I'm trying really, like all of us at Stable C, we're trying really hard to steer away from the banking narrative. But yes, in future, if you take that 10-year perspective, yeah, we will most likely be a private banking solution for
Mhm.
democratized version of that. Yeah.
Yeah, fascinating. So, what's one thing that you're actually trying to figure out right now in your business?
Mm. Yeah, it's a great question. I mean, the one thing that we're actively trying to figure out is two things really. One is, so we build directly into ERP systems like a QuickBooks or a NetSuite or Oracle or SAP. And we have advisory services. So we take a lot of that data, we build our own model weights on top of it, and then we offer that out to our consumers or like to our customers so that they can essentially query their own transaction data and use it for different services. Now we've got like strong signal on like the first value proposition for that, but I'm curious mostly for like owner operators in the real economy, like what are their biggest back office pain points? And that's something that we're trying to figure out because we hear a lot like, yes, we don't have access to savings products. Okay, we can solve that today. Yes, cross-border payments is frustrating, slow, and expensive. Yes, we solved that today. So we're looking for that third kind of pillar that is like, what is the other, one of our VCs always talks to us about morphines versus vitamins, where
Mhm.
it's kind of a crude analogy, but if you go to the hospital and you're in dire pain, you don't want to be sold vitamins. You want some morphine, and that's what you're going there for, right? And when you're in a startup and you create products, you're really looking for that morphine of like people just cannot live without this product. And then you can sell all the value added services around it, which are essentially the vitamins. And so for us, we found two morphine like products where like there's a real pain point for
Mhm.
accessing capital markets. Primarily, there is no ability to access that today. And then second, cross-border payments, slow, difficult, expensive, opaque, all the things. Solve that. So the third one that we're trying to figure out now is like, how do we A/B test quickly enough to figure out we have a treasure trove of data building into ERP systems. What is the most highest signal to noise product that we can build using a diverse data set to help owners kind of operate their back office a little more efficiently?
So when you say highest signal to noise, is it the highest signal to noise? Is it the ratio of signal to noise? So what is the product which you can detect as being a need in the market? Is this what you mean by?
Yeah, yeah. It's like, what is that one pain point that is so resolute that people are like, I would do anything for
Mhm.
have this thing to solve. There's all these value adds of like cash flow reporting and like automating some of your tax stuff at the end of the year,
Mhm.
which are all like nice to haves. I don't know if it's well, we're curious. We're trying to figure out like, what is it that like folks will say, I've got all this data in my ERP system. I would love to know one, two, three things and have ABC automated. So my back office can run a little bit more efficiently and my accountant doesn't have to ask me every quarter end where is X, Y, and Z statement.
Yeah, I mean, I've got some ideas, but I'm sure that you've already thought most of it, so I'm not gonna share them. So, if someone is listening to this who is a small business or medium-sized business, and they've got some cash sitting around, or they'd like to invest, but they're not big, they don't have big enough balances, or the transaction costs are prohibitive for their size of investment, whatever the reason, but they are curious about exploring how to have access to better FX rates, more investment products. Where can they learn more, and how can they connect with you?
Of course. Well, connect with me on LinkedIn, Tanner Taddeo, pretty easy to find. And then platform is stablec.com. So free to sign up, no cost whatsoever. Also, no cost to use the platform at all. So feel free to sign up right online. And then, yeah, typically takes us 2 days to run through the KYB document requests.
Mhm.
And then you're up and running. So pretty simple. Stablec.com, free to sign up and start putting your capital to work. We try
Awesome.
and make it as seamless as possible.
So I'm just wondering, the name of the company, is it something to do with stablecoin? Is it the sea of opportunities for stablecoin?
It was stablecoin for sure. So we started with the word stable and then C because we wanted to provide a sea of liquidity. both for FX, because you need, like, we do B2B settlements, which are typically large transactions, low volume. You're not doing, you're not doing 20 $10 million transactions a day. You're typically doing one 10 million transaction a week or every other week. But you need a deep pool of liquidity to service that. And then also from a capital markets perspective, we wanted to be able to provide a sea of liquidity there for different investment options that companies could access based on the seasonality of their cash flow or the risk tolerance that they have as a business. So stable meets C, so stable C.
Okay, well, if you want to keep your bank but upgrade your capital, then reach out to Tanner Taddeo, the CEO and co-founder of StableC. He'll get you more investment opportunities that maybe you have not had access to. And if you enjoyed this episode, make sure you subscribe and follow us on Apple Podcast. Do not miss any episode with exciting entrepreneurs like Tanner. So thanks, Tanner, for coming, and thank you for listening.
Thank you, Steve.
That's it for this episode. Keep moving your business forward. Subscribe at stevebreda.com/newsletter.